5 things every investor should know. The smartest move to make while investing is to try and future-proof where you're putting your money. After all, most investments are done for the case of the future, whether it's to increase your wealth in the long run for the simple sake of increasing your wealth, or whether it's to save for retirement or for your family. There are many ways to accomplish this goal, but among them, there are things to look for in investments to future-proof them. So what are these things? Let's talk about them. Hey guys, welcome to our channel. In today's video, we are going to talk about 5 things every investor should know. If you want to find out more about it, then stay with us until the end of the video. Also, before we start the video, don't forget to hit like, subscribe to our channel, and ring the bell icon for more amazing videos. And let's get started. Whether you're a novice or an old hand, there are some investing fundamentals that everyone should know. Some of the things we will go over in this video might sound rudimentary, but these important basics can help you make informed decisions about your money and build your confidence as an investor. So let's talk about these one by one and make your investing skills better. Number 1. Stocks, bonds, ETFs, and mutual funds are the basic building blocks of many investment portfolios. The number of investment choices out there can be overwhelming, especially if you're still somewhat new to investing. Many people choose to invest through professionally managed funds or portfolios, which usually means they don't have to handpick individual securities on their own, because stocks, bonds, mutual funds, and ETFs are the basic building blocks of any investment portfolios. Let's do a quick review of the differences between these types of assets. Stocks. When you purchase a stock, you own a piece or a share of a company. Stocks are also sometimes referred to as equities. When the company makes a profit, they typically distribute dividends to their stockholders. Dividend payments may come in the form of cash or additional shares. Bonds. A bond is a loan from an investor to an organization or entity, like a corporation or the government, that's looking to raise money to help pay for certain projects. Think of it as an IOU. Bonds are a type of fixed income investment because they typically provide a predictable rate of income in the form of interest payments. Exchange-traded funds, or ETFs. An ETF is a type of financial product that's made up of a large collection of stocks, bonds, or other types of securities. For example, an ETF can contain a variety of bonds, stocks, or a mix of both. Money market mutual funds. A money market mutual fund is where investors pool their money together to invest in a portfolio of securities. A money market mutual fund typically invests in high-quality debt instruments, such as certificates of deposit and U.S. Treasury notes with short maturity dates. Number 2. Investing involves risk, and it's important to focus on the long term. Some people might hold back from investing more of their money in the financial markets because it's generally riskier than keeping your money in deposit accounts like savings accounts or CDs. And let's be honest, none of us like losing money to a bad investment or a volatile market. With savings accounts, you can earn interest on your deposits. Institutions typically compound interest daily, monthly, or annually. And if you have an account in an FDIC member bank, your money is federally insured up to a certain amount. Risk tolerance varies from person to person, so it's important to understand your personal level of comfort when it comes to investing your money. You're probably thinking, why would anyone want to put money into something when you could potentially lose it? That's a fair question. Think of it this way. While there's potential for losses with investments, there's also the possibility that you'll see some nice gains. A large part of investing is about figuring out how to properly balance risk and reward, and which risk management strategies make the most sense for you. Sure, watching financial markets go up and down can be nerve-wracking, but keep in mind that periods of market turmoil are normal and expected. That's why it's important to take the long view with investing and not let short-term market volatility distract you from your long-term money goals. Generally speaking, staying invested for the long haul puts you in a good position to reach your goals. Number 3. Diversification can help manage investment risks. When it comes to deciding where to invest your hard-earned money, we would all love to have a sure thing. But as we mentioned earlier, investing involves risks. So a key to success is learning how to manage that risk in a smart way. One common risk management strategy that you're probably familiar with is diversification. This is where you divvy up your money across different types of investments or assets in order to help spread out your investment risks. You may know the saying, don't put all your eggs in one basket. That's the basic idea behind diversification. Diversification can help minimize risk. but it can't eliminate all risk. While it might sound like a basic strategy, it's a powerful one. By investing in a mix of assets like bonds, stocks, and ETFs, your portfolio is less likely to be completely wiped out if some assets are impacted by market volatility. If a certain class of asset isn't doing well, other assets in your portfolio might be able to help cushion the blow. In other words, diversification can help limit your exposure to the risks of any one particular type of investment. Think about it this way. If you only invest in the stocks of one company, you risk losing your entire investment if the company goes under. Now, while diversification can help minimize risk, it can't eliminate all risk. Just as diversification doesn't guarantee gains, it also doesn't completely shield you from losses. There's no such thing as a perfectly safe investment, and if anyone tries to tell you otherwise, be wary. Number 4. How you choose to invest depends on your time horizon and risk tolerance. Time horizon may sound like a concept straight out of a sci-fi novel, but it simply refers to the amount of time you're planning on staying invested, and how long you plan on holding onto your investments typically depend on your age, investment strategies, and financial goals. Investing offers opportunities for you to put your money to work. People who won't need to tap into their investment for a while, for instance, those who are a long way from retirement, would generally have a longer time horizon than, say, people who are investing money for a home down payment that's 5 years down the road. If you already have a time horizon in mind, another question to consider is, how much risk are you willing to take on in your investment? That is, what's your risk tolerance? Risk tolerance varies from person to person, so it's important to understand your personal level of comfort when it comes to investing your money. So, both your time horizon and risk tolerance could help determine the appropriate mix of investments in your portfolio, or how you divvy up your money among stocks, bonds, or other securities. On the other hand, an investor who is farther out from retirement and has a higher tolerance for risk may choose to hold more stocks than bonds in their portfolio. The rationale is that investors with a long time horizon have time to weather the stock market's fluctuations in hopes of earning higher returns over the long term. Now, this isn't to say bonds are better than stocks or vice versa. Both of them play a role in your portfolio. How you split your money between bonds and stocks will depend on your personal finance goals, as well as the factors we mentioned above, like risk tolerance and time horizon. Number 5. Investment income may be taxable. Taxes, they're not the most exciting topic, we know, but we're bringing them up because they're an important aspect of investing. Each year, your investment firm or account provider will send you any relevant tax information about your holdings. Keep in mind that investment taxes can be complex. There are different tax rules for different types of investment income. So don't hesitate to ask for help from a tax professional to understand which specific rules may apply to you. In conclusion, investing offers opportunities for you to put your money to work. Whether you've been investing for a long or are a relatively newcomer, it's important to know your goals and ask yourself a few key questions, like what are you investing your money for? How long do you want to stay invested? How much risk are you willing to undertake? Once you have answers for these questions, you are finally ready to put your money to some good use. And this is it for today, guys. What are your thoughts on today's video? Which investment did you like the most? Share with us in the comments below. Also, don't forget to hit like, subscribe to our channel, and ring the bell icon so you don't miss any of the latest updates. And thanks for watching.